Market's having a rough sell-off today to start the month, and our next guest says there could be more pain ahead. Let's bring in Dan Suzuki, portfolio strategist at Richard Bernstein Advisors. Dan, good to have you back.
Thanks, guys.
So what is the catalyst that keeps a sell-off going?
I agree with everything that Guy said. I mean, always, but especially today, because what do you have to hang your hat on? Why be a hero today when all the news is really bad? I mean, our view is that profit, like this market this year has been riding on hope, right? Three hopes. Hope that earnings was going to bottom and rebound, hopes that the Fed was going to come in and save the day, and hope that we're going to get trade resolution. I think all those things have got called into question, and the data on profits, which is the most important part of it, is horrible. I mean, we just got the ISM number out today, really bad. And you guys were talking earlier about the consumer. That's the shining horse, the thing that's holding up this economy. I don't think the consumer's that good. If the consumer's so good, why is consumer discretionary? Why are their earnings contracting as of the second quarter before the tariffs hit? Why do we have this big slowdown in the services PMI, one of the biggest you've seen in the last few years? I mean, all these things are telling you that things aren't that great in the economy. It's not just an industrial part. And you have to go back and look historically. When you see slowdowns, the consumer is always lagging. If you look at consumer confidence, it's always high before the peaks of market. So I don't think it's a good indicator to hang your hat on. I'm looking for anything that actually leads earnings to tell me that things are turning around. I just don't see those signs. Any indicator that I look at, whether it's core crude PPI or the actual earnings data themselves, PMI, ISM, you name it, durable goods, all this stuff is going the wrong direction. So why hang your hat on this hope trade when there's just no data to support a rebound anytime soon?
So everything you're saying, kind of music to my ears, because I agree with you. But at some point, are there companies that you would find, all right, the value is so compelling here. I understand there's all these bearish, elements to the story, but at some point, valuation is such that
RBA, we're a macro firm, right? So we look at things from a 50,000-foot view, and there's a very strong history of when the profit cycle is slowing, defensive, higher quality sectors and companies always outperform. And you're seeing that right now, and you pretty much always see that. So we think there's a good case to be made for continuing to be overweight healthcare, staples, real estate, and utilities. Now, obviously, the first thing that one of you is going to come back with and say, these are really expensive. Well, I looked at the history of this. Part of the reason that they look expensive is because you're looking at the defensives relative to the cyclicals. Now, the cyclicals, you can't look at cyclical earnings like that. Anybody who's covered CAT would know that you actually want to sell it when it's cheap and buy it when it's expensive, because you're talking about peak earnings. If you look at the U.S. machinery sector, it didn't look cheap, as in traded at a discount to history until 2005 and 2006, and it didn't get expensive. It was, and it didn't get looking cheap until 2009, right? So that's the typical sector. And so you're looking at defensives relative to this. I looked at the history of the last 3 or 4 cycles. The defensives almost always look expensive going into it, and they actually still outperform. So I don't think it's a really great argument.
What is the premium that they deserve? I mean, as an investor, you still want to be disciplined, even though they outperform. I mean, it's not at any price. It's not at any valuation, I would think.
Well, I think it is, because you should look at, I think you have to differentiate the defensive sectors a little bit. Obviously, with real estate and utilities, there's a huge bond component. And I would argue that relative to everything that's tied to the bond markets, actually real estate and utilities don't look that expensive relative to long-term treasuries or things like that, or high yield bonds and things like that. But in general, if you look at this, there's this very strong history. People always want to say, this time is different. Look at this company dynamic here. Healthcare's got all these political issues right now. But go back and look at the history of that sector's relative performance. When it has massive outperformance, it's during periods where the profit cycle is slowing. And when it has massive underperformance, it's when usually early in the cycle when you see a massive pickup in earnings out of a profits recession. So I think that's still going to be the most important thing, and that's what we're looking at today, is increasing risks of a profits recession. I think that's the most important thing. Now, I'm not saying buy now for the next 5 years, hold your nose. There will be points that if you start to see signs that the profit cycle comes back, absolutely, those are not the things to own. But for the time being, I think it makes a lot of sense, regardless of the valuations, so long as the fundamentals are holding up. And the fundamentals for those sectors are actually holding up pretty well. Especially healthcare, which has underperformed this year. I mean, it's got some of the best earnings revision trends, some of the best sales growth trends, some of the best beats relative to expectations. So, and it's actually trading cheap relative to history.
Dan, thank you. Good to see
Thanks,
you.
guys.
Dan Suzuki of RBA.
Love
I know you
Dan.
loved it. Well, because he's
Well, you guys
right
sat
all the
it down.
time. I
Just hung it
mean,
out. Jeez.
Well, we chatted off camera. I think Dan makes excellent points. I mean, I have to say that because he agreed with me. But, Con Edison making an all-time high today, up 2% on a lousy tape, is great for Con Edison. But you have to say to yourself, does this make sense in the context of a broader market? So I agree. I mean, I think you're hanging your hat on fewer and fewer things. And if you think the Fed is somehow going to bail us all out, you have to ask yourself, is the Fed the fireman that's putting out the fire, or are they the arsonist that's adding gas? I would suggest it's the latter.